Hi, Kevin and Gary here from Chicago. This is our first quarter 2016 market overview. You know, we were waiting for the Fed to raise rates, which they did, albeit very small, a quarter percentage point in December. Now they're talking about maybe lowering rates, or even going negative like it's happened in Bank of Japan and Europe and so forth. So it's really kind of crazy, and that's coming out of this whole thing that took place in January with the markets really gyrating a lot, even into February and so forth. So you kind of got to ask yourself, what's up, Kevin? What's going on here?
Well, we've had the government with an accommodating monetary policy since 2008, 2009. And that's been the issue that everyone's been talking about on the economic front, is how does the government begin to scale that back? And they've been waiting for economic activity to kind of take over so that the monetary easing, they can pull back on it.
Right.
And both previous times on QE1, QE2, where they began to do that, you saw the market and the traders selling off because they didn't see the visibility of the economic progression, and they saw that easing being taken away. And that money, let's not fool ourselves, that money has been going into asset prices because it hasn't been going into economic activity. So there's a large element to where prices have been extended because of this, and the market's been reacting negatively for the prospect of the easing being taken away. So the market recovered after it was down, 10 or 15% May to August last year, and it began to recover when the Fed started coming out with more dovish comments. This last go-around after they increased rates, the same thing kind of happened, and with the China issue and energy issues in this country, and the last week fears about some of the European banks, they're thinking, okay, well, we might have to be careful again here. We might have to extend this. Well, maybe not necessarily raising rates, but staying status quo or the prospect of negative rates. So the markets behave favorably on that. Ultimately, economic activity is going to have to carry the ball.
Yes.
And I guess one positive is you got earnings. While it's kind of a plowhouse kind of a situation, they're still positive, especially if you exclude energy, which hopefully you'll see a lagging effect of declining oil prices seeing its way into consumer purchases and things of that nature. But earnings have not been recessionary. Unemployment has not been recessionary. So that greater issue of people being fearful of that, markets will go down 20 to 30% in a recession. Well, do we see one? You know, we're erring on the side thinking that's probably not the case. It could happen, but in a lot of respects, if you look at this market, most stocks have traded into bear market territory already, where it'll still be volatile, but most stocks, 60% or more, are down more than 20%. So it's an interesting vantage point to look at it that way.
Good point, and that brings up what happened last year. Last year, the S&P was up, 1.5 points.
Right.
But if you took the FANG stocks out, Facebook, Amazon, Netflix, and Google, now called Alphabet, it was down 4%. So, there was money seemed to be driving in certain areas, and as we know, it's more been towards growth, and these large cap growth stocks and values been out of favor here for quite a long time.
Well, momentum works, and then it doesn't work. But ultimately, if you buy something and you feel comfortable in the value, and that you can feel comfortable owning that asset over a long period of time, that's the area that, over long periods of time, value works. It's just been an extended period of time where the growth and the momentum have carried the day. And I think if you're focusing on value and truly not getting extended and trying to chase areas of this market, that's where you want to concentrate your risk management.
That's funny you say value. We looked last year, and Warren Buffett, everybody believes, is a great investor, has done very well for a long period of time. He was down 11% last year, and that's kind of a reflection of what's happening with the value stocks out there. So as you said earlier, we have this minus 20% in a lot of stocks out in the stock market right now, but overall we have not seen a bear market. Brian Westbury article you and I read recently is basically saying this is an emotional correction, not a fundamental correction. There's just a lot of emotion being driven by politics and all sorts of other factors going on here. It just nothing else adds up to seeing a recession on the scene, but you never know. Things can get worse.
The most often quote is 19 of the last 7 recessions have been predicted. And it's certainly between China and oil is the topics of the day to worry the market. But are the earnings there? Are they great? No. Is the market fairly valued? Is it overextended? That remains to be seen. 5 years out, however, the growth buckets that you have, they might be in the lower end of the ranges, but you want it to be, I think, be concentrating on the area that's value and it may be less so of the momentum.
Yeah. So stay diversified. Make sure you stay to your core path of what you're trying to do, and then maybe by next quarter we'll see some of the stuff ferret its way out with the Fed and what's going on with the gyrations in the market and other things. So have a good quarter, and we'll talk to you next time.